Most people think they can't afford an investment property because they don't have a pile of cash saved up. But cash from your savings account is just one source of funding. Typically, most Australians have potential investment equity in two other locations: superannuation, the family home. Investment using your super may be a possibility, but in this video, we're going to show you an example using the equity in your own home. Let's say your home is worth $600,000 and you have a $200,000 mortgage. Providing you meet the bank's lending requirements, which comes down to your income and expenses, they'll lend you up to 80% of the value of your home, minus any debt already against it. So in this example, 80% of your $600,000 home equals $480,000. Subtracting your current $200,000 mortgage gives you $280,000 of potential investment equity. How cool is that? So now, how can this effectively be used to buy an investment property? Let's say you're looking at a $500,000 property in a great location. You'll need to pay a 10% deposit plus standard purchase costs like stamp duty, legals, etc. This $70,000 comes directly from your new equity loan, and the balance of $450,000 for the property is a standard investment loan. Notice you have borrowed all the money and not put any of your own cash towards the investment. This is usually the most effective investment finance strategy, as it makes your investment property as tax effective as possible. If you do have spare cash, you should use that to pay down your home mortgage, as that debt is not tax effective. So now you own an investment property, but you're still wondering how you can afford the payments on these new loans. That's okay, another video in our series will cover this, and we're sure you'll be amazed at how it's done. So let's stop for a second. What was the original reason for wanting an investment property? To create greater financial security, right? Well, since the beginning of recorded history, Australian residential property has effectively doubled in value every 8.2 years in the major cities of Melbourne, Sydney and Brisbane. But what if we took a much more conservative approach and said it will take 15 years to double? That means that over 15 years, while your new property is making its way to be worth a cool $1 million, it's essentially earning just over $33,000 per year in growth. And since you used $70,000 to buy this property from your equity, that's a 48% return on your equity. No bank or any other investment can give you that type of annual return. And remember, you did all of this without having that pile of cash you thought you needed. Not to mention, your equity before this investment was earning you nothing. But what happens if you're out of work for a while, or if you don't have a tenant for a few weeks? There is one more vital piece of information about financial preparation before you invest. It's critical that you structure your borrowing so that you have cash reserves for a rainy day. And it is possible to have that structure, even if you currently have very little cash at the bank, which will enable you to ride through your worst case scenario. If you really want to understand how this information can apply to your personal circumstances, contact us today to find out how we can help you join the 1.9 million Australians already using investment property to plan for a safer financial future.